All right, good afternoon, everyone. Money Show is pleased to welcome Harry Dent Jr. He's a founder and senior editor at Dent Research, an economic research firm specializing in demographic trends. He dedicates himself to identifying and studying demographic, technological, and geopolitical trends. Mr. Dent's track record has accurately predicted Japan's collapse in 1989, the dot-com bubble bust in 2000, and the housing bust in 2006 to 2007, among many other things. He is the author of several books, including his latest book, Zero Hour, Turn the Greatest Political and Financial Upheaval in Modern History to Your Advantage. Harry, it's an honor to have you here today. It's all yours, sir.
Thanks, Mark, and welcome everybody. Good afternoon. I do look at demographics. It is the best way to predict what people will do, especially when it comes to spending and investing their money. Nothing's better than it, but I also have found that technology cycles and geopolitical cycles are very important. So I've spent the last 30, 40 years blending this into an economic model that basically says the economy is a lot more predictable than we've been led to believe. And I have been able to see a lot of things. I started in the late 80s, early 90s with my first book saying we're going to have the greatest boom in history. Why? The largest generation in history, the baby boom, was going to cause that boom as they grew up and went through a predictable spending cycle. The problem is, since late 2007, when that peaked on cue, we've been living off of money printing to deal with the natural demographic decline. And that is going to come to a head, I think, literally in this year and next. And so investors have to get ready for what I call a great reset to get financial markets back down to reality with the economy. And then we can have the next boom with the young millennials, which we've heard a lot about, but they're never going to be the size, relative size of the baby boom generation and the boom we saw from 1983 to 2007. So let me get right into it because some simple stuff, but important. Leonardo da Vinci put it this way, said simplicity is the ultimate sophistication. Most people think, you got to really dig down and get all the details. Well, yeah, but no, the most important trends long-term are simple and highly projectable, especially when people spend money. Now, here was my first breakthrough indicator back in the mid to late 80s called the spending wave. Now, here's how simple this is. I knew from new research by the Bureau of Labor in the US starting in 1981, just when I was starting my research, they documented exactly when people spend money by age. And the peak was age 46 for these up and coming baby boomers back then. So I took the birth statistics for the giant baby boom and adjusted for immigrants and created the spending wave, a simple 46-year lag, because that is when, back then, the average person peaked in spending at age 46, average, not all of us individually. And today it's 47 for the millennials and going towards 48. So that's an important, simple fact that allows us to see how new generation causes the longer term booms and busts. And look at this first chart, the spending wave, and the correlation with the Dow adjusted for inflation. Very good long-term correlation. I'll show how we've gotten away from that with all this stimulus real quick. And again, here's the evidence behind it. This is actual data, which the government takes every year now, and I get updates, okay? This is the spending cycle. Into the workforce, 18 to 20, people get out of high school and partial college is the average, and then spend dramatically more as they're earning more in their careers and raising their families, and no better motivation than kids to earn and spend more, and peak at age 46. Again, now it is just turning 47 millennials, but this was the baby boom chart. And there's kind of a plateau where the more affluent people who get educated longer and spend longer keep spending, but overall peak at 46 and a steep drop off after age 54. So this is important when new generations go up and down this cycle. And we create these booms about every 40 years. And then the next generation comes along while the old one's declining to pick up the slack and create new growth again. And again, I'm not going to get into this today, but I've combined over the last 30 years, 4 key cycles. I've sifted through every cycle that could matter. And here's the one you see in the middle, the blue one. That's the 40-year approximate demographic cycle. But we can time that precisely. Above that, the most powerful one, long-term, innovation, new technologies, from jet engines to computers and things like that. And from the printing press to computers over even longer cycles, but 45 years is one of the most clock-like cycles I have. And this with our demographic, and then below that, a 35-year, about 17 to 18 years with the geopolitical situation is kind of good, and then it's not. And we're just coming through a bad cycle in that's turning around. But when I put all these cycles together, along with a well-known decennial cycle, where we tend to have recessions and downturns in the first few years of every decade, then I get 4 cycles. And there's times when they point up strongly, as we've seen in recent years, and times when they point down together. Look at the gray shadings here, early 30s, mid 70s, and 2020 to 22, 23. So we're in this difficult period, and central banks are fighting it like crazy. And I'm saying they're going to lose this war. So what have they done as things have slowed since 2007, the peak of the demographic cycle, which I showed earlier? And now with this recent weakness in COVID, they just up and up. They just printing money to cover this over. Well, unless you get something for nothing, and I've pretty much learned the opposite in real life, and I hope you have too by now, then this is not going to last, and this is not good economics. Now, there's an important other cycle. When I look at long term, every 90 years since the Industrial Revolution, remember I said that 45-year technology cycle, every other one builds on each other. Okay, like steamships and railroads and automobiles and computers and things like that. And so you get bigger cycles every 90 years. And you look at this long-term chart, the biggest bubbles and crashes have been almost exactly 90 years apart. The last one was the late 29 to 32 crash, and now 2020 to 22, 23 is this next cycle. And again, central banks are fighting it hard, but I'm saying they're going to lose this battle, and I think pretty soon. Here is just an example. And again, I could spend a half an hour just on this chart or more, but just things like steam engine and steamships and railroads and telegraphs and automobiles and electricity, internet, portable computing, and now biotech, nanotech, and crypto technologies. Okay, these things come along, they move into niche markets first, don't have a giant impact, although they're all sexy and they boom like crazy and get overvalued, but then they move mainstream on an S-curve. S-curve is another predictable pattern that I can predict. Once we get near 10%, I can predict the rest of an S-curve very accurately in most cases. So again, when generations spend, when new technologies kind of incubate and then finally hit that 10% breakthrough point and move mainstream, all predictable. Economists have no clue in this. They don't study this sort of stuff. It's not taught in economics. Now, what normally happens, everyone's like the last time we had a big major 90-year cycle, you see on this chart left, when the cycle changed, that red circles, that was the peak in 29 and the crash into the 30s and 40s. Well, you look at this time at the top of the right side of the chart, no, we started to crash in 2008, right when I predicted it would, all the way back to the 1980s, that 2007 would be the peak and 2008 would be the beginning of the decline of baby boom spending and a weaker economy. Boom, we never let the economy reset, restructure, get rid of a lot of bad debts and zombie companies. And so we're in this kind of like, oh, we need to live on constant stimulus. That's not good policy. Never has been. And again, most reliable cycles, a long-term of the stock market, 20 and particularly 40-year cycles on this demographic. Again, I've been saying back to the 80s, that late 82 was the bottom of a long-term 40-year cycle, and the next one will be late 2022. That's a year and a half from now. So the central banks are pushing against natural cycles that say, and I've been saying for a long time, that late 2022 and into 2023 for the economy, kind of the hangover, would be the worst time in our lifetime for the economy. And of course, we're not seeing that yet. Why? Endless money printing, as I showed before. So again, we have the rare convergence of long-term cycles pointed late 2022. The most important point before this was late 82. We got the 90-year super bubble and great reset cycle, as in 1932 and 1842, the biggest depressions and bottoms in American history. An 80-year four-season cycle where the winter started in 2008 and will end in 2019, before 1942 and now in 2022. 40-year generation cycle, 20-year cycles, and 10 years. I said all of these are converging. So it's going to get harder and harder for central banks. And of course, you're seeing they're having to print exponentially more money, especially since COVID. That was a shock, but it was a short-term shock to keep this bubble going. And nobody can do this forever. They don't have magic, okay? All they are is taking the easy way out. Weak economy, instead of restructuring debt, instead of incentivizing new industrial development investment, they're just printing money to cover over and make everybody feel good. Not good policy. So here's how bad a policy is. Here's that spending wave again, updated. Now, where are we now? Look at the stock market, highlighted in yellow here, how overvalued it is compared to where fundamental trends. We should be at the bottom of this baby boom or echo boom decline into 2020 to 23. And here we are, the stock market acting like we're in the best times ever. This is only because stimulus that goes into financial assets overvalues financial assets. Bonds are acting like there's no inflation and it's 4% going on 5%, okay? Stocks are acting like we're in the greatest economy ever where we should be barely growing until 2023 forward when the next generation comes along. So the markets are totally out of whack because governments had taken over the economy and decided we will not ever have a recession again, the dream of all economists, which shows to me economists do not understand the economy. Anybody in business knows if there weren't these down cycles and challenges to business, that's where innovation comes from. That's when you wipe out the weak businesses and reward the strong ones. This is how the economy actually works in real life, and they're working against this. So look again. So just think, what the Dow should be at 12,000 now, and it's at 35, okay? What does that tell you? And when you have a correction, it's always going to go past that. So I'm saying literally within the next few years, we could see the Dow at 4,000 to 8,000. Are you ready for that? I know this sounds outlandish, but I stood alone predicting the incredible boom in the late 80s, early 90s. People said, oh, America's done. Japan and Asia's taken over the world. And I said, no, the baby boom is here in Europe. And that's what actually happened. Now, this is 120% difference, okay, from where the stock market is where it should be. I can explain that, a lot of things, but just one factor pretty much explains it. It's the difference between this line, earnings, in black, earnings per share, and actual total corporate profits. So how do you get earnings per share growing so fast when profits have been sideways since 2012 and only had a brief recovery from the 2008 recession? Well, you buy back your stocks. Companies have taken all this cheap, easy money and low interest rates and just bought back their stocks and shrank their float. So it looks like they're growing faster than they are. So it's a total fake economy. My friend Robert Kiyosaki, that's his favorite word. I think he had a book by the name Fake. So what we have, and look, how stocks and, financial assets bubble up always to some degree in a boom and go down and bust. But look at this. This is an unprecedented bubble in financial assets. And just to get back down to normal reality, that we'd have to see a $60 trillion correction in financial assets. So 120 some down to 60 trillion. That will cause more like a short-term depression than a recession. That's going to be the biggest shock we'll see in a life. That's how it happens. Instead of dealing with economy, restructuring, you just keep putting money in, free money from the outside. It just goes into building up financial assets because the economy's not really growing that fast and businesses don't need to invest for more capacity and stuff. So it just goes into speculation until the bubble bursts and then this money's suddenly wiped out. And investors are caught by surprise just when they thought the markets would never go down again, we'd never have a major recession again. And here it is globally, okay? This is the important number to remember. Walk away from this presentation. In the world today, and it's probably already another 10 trillion, but $525 trillion in financial assets, stocks, bonds, and all that sort of stuff in real estate. Okay, and real estate's the biggest. And in a major reset like this after a bubble, like the 20s going into the early 30s, 40 to 50% of that will disappear. So that's 200. So we just had 60 trillion in the US to get down to normal, 225 plus globally, $trillion. Global GDP is 80 to 85 trillion. So this is 6 times GDP in financial assets when it should be 2, maybe 3 normal, and losing 2 to 3 times the total GDP, disappearing in a short period of time when these bubbles burst. And that's the one thing bubbles do. If you study them, and nobody does, the bigger they get, the bigger they burst. There are no exceptions in history. Now, zombie companies, ever since they started printing money, well, banks don't foreclose on companies, companies don't fail, nobody fails, banks don't fail. So we just keep getting more and more zombie companies. Zombie companies, now now that's numbers up to 21%, by the way. Zombie companies are large companies, not small businesses, who cannot meet their debt service. They're just barely getting by, and banks and the Fed, and nobody's forcing them to come clean. So they just keep limping along. So you get a zombie economy. Now, here is my favorite pattern in stocks. There's many of them. It's called a megaphone pattern, where you see higher highs, but, and this is when it comes at the end of a long boom, when investors are used to the market always coming back at higher highs, and they don't worry about corrections, and you just buy more. And so what the telltale sign is, for the first time, oops, every time you have a correction, you get a lower low. So this happens for 3 rounds until right where we are, you peak. And if we go back and break back below about 4,300 here on the S&P 500, the target is 2,100. That would be a 54% crash from recent levels. And listen to this, in 2 to 3 months. So this is why I'm urgent here. I know I sound like, oh, Chicken Little and stuff, but this is what happens at the end of a bubble like this. And this is one of the most reliable patterns. And most investors and analysts don't see it because these megaphone patterns are not coming. They come at the end of long 30, 40-year booms. So people like me see them because I love this pattern, and I'm looking for this top when people aren't. Now, Shiller, adjusted. People say, well, stocks are not quite as overvalued as they were in 2000. Well, they were the more overvalued there than any time in history by far. And we are back close to those levels, I'll show soon. But what I do is I take Shiller's cyclically adjusted PE price earnings ratios and adjust them for the same. He does a 10-year average, just move that up. I do a 10-year average growth rate for the economy. Don't you think price earnings ratios should be higher in a high growth versus low growth? And we've had a low growth economy since 2008, okay? When I adjust for that, price earnings ratios are higher than ever, not a little lower than last time. And even a little lower than 2000 would be a worry for valuation. Here's a classic look at, okay, here we go. Here's the final rally after the COVID crash and the massive, now here's what you got to get here. They've been printing money since late 2008 and escalating and escalating. You would think after 12 years, the economy wouldn't need constant help if it had any fundamental strength from demographics and technology, which it doesn't. Remember in 2018 when they said, oh, we're going to taper a little bit, we don't need this anymore. They didn't taper for more than a few months before they had to start pushing the button again because the economy started shrinking and started growing slow and rapid. It needs this stimulus because it's dead. So since the COVID hit, that was a big shock. Now, the problem with COVID was that was such a shock that governments used that as an excuse to just go hog wild. I mean, no longer double down, quadruple down, more than that. I mean, between the fiscal stimulus and the monetary escalated double or triple, but then they added trillions of fiscal stimulus. So that I've added up 65% of GDP in a year and a half was committed to stimulating the economy. If you have to put that much in to get it to keep barely growing, is your economy dead or what? So I'm looking for a final pattern here. And this is just one way to look at this. Okay, we came out of that COVID shock, massive, massive stimulus. And yes, the economy's growing 4 or 5%, but man, I ought to be growing 20% with 65% of GDP poured into it. And it's already showing some signs of slowing. I think you'll see more of that in the next year. So here's a natural pattern that we go up, that we'll hit a little over 4,500 around, in the next couple of weeks or so, and then break back through this bottom trend line around, say, 4,200-ish, okay? That would be a danger sign. You could either start selling at the top of this, or, and I would say, get more serious if we break this bottom trend line, because this market keeps going. So it's safer to sell at this bottom trend line, but it could break fast from there. But just note, and this is typical, and I've done my homework on this. studied every bubble burst known to mankind in modern history, okay? When a bubble of this magnitude peak in stocks, the first crash is 42 to 50% in 2 to 3 months. In other words, people can stay in and we can't lose. And then instead of having a 20% correction and back to new highs, you get this fast crash and it's over. And that's when people really get caught. And this thing says, if we break 4,200 here, look out, we could be at 2,100 to 2,200 in no time. And most people will wait till then and then panic and wish they'd have waited for the bounce after that. But that would be a signal to me that this boom and this bubble is over. So look for that ahead. Now, what's the safe haven? Everybody's going to tell you Bitcoin, gold, all this stuff. No, no, no. Look at 2008. Look at the early 30s. Gold is not. Gold was one of the biggest, but gold bubbled up just as much as stocks, just at different times. Gold has been deleveraging a bit and will more. Gold, I think, is going to end up at $1,000, a little less. That will be one of the least crashes we see in the next few years, if I'm right. It is Treasury bonds. The safe haven is the best bonds that will never default, no matter what, even if they got to print money to pay off them, of the strongest and largest government in the world, the United States. And I know everybody criticized that. We're still the largest country in the world, and our demographics, as weak as they are near term, are stronger than Europe and way stronger than East Asia, including China and Japan, okay? Not the third world, okay? So Treasury bonds, you look back at the last crash, 2008, what really did well, especially at the worst, were the Treasury bonds. Gold edged up at first and then crashed 33% in just a few months, okay? And its Treasury bonds were the only safe haven, and you want the longest term ones, 30-year. Now, corporate bonds are another sign that I use to predict the top. So back in 29, the corporate bond basically peaked. The inverse of their yields, and their value peaked 1.4 years before the top in late 29, and then crashed with the stock market and continued to lead down. Well, this time around, if that's the case, hey, it says by the latest it should be January, but I think with things so strongly pushed, this is going to happen sooner than later. But by the latest, we're going to see a crash in 2022, and I'll stand by that prediction. Now, what's the difference? Okay, why not buy a 10-year Treasury bond? Because look at this, look at the difference in the gains in the type of scenario I see of going to near zero rates, a little above zero for the 30-year and about zero for the 10-year. And that would not be hard to get to, and many governments in Europe and stuff in Asia are already there. Look at the difference between holding a 30-year Treasury bond in the scenario I'm painting, 38% gains versus 9.5% for a 10-year. A zero coupon Treasury, which strips out the interest and gives you a little more leverage, almost 50%. TLT, which is 20-year average compared to the 30-year, 22% versus 38%. I want the 30-year Treasury bonds to safe haven. I do not want gold, and God forbid I do not want Bitcoin. It is the bubble of bubbles, just like the dot-coms were in the first big tech bubble. Now, let's look at crypto real quick. This is a very good model. I've been digging into this because this is the leading edge of the next technology bubble, but it's in its infant stages, just like the dot-coms were in 98, 99, 2000. They drove the bubble the most in the last few years and then crashed 95%. So here's Bitcoin jumping up this fundamental model, which has been very darn accurate. It's saying even at 65,000 recently, it really ought to be at 100 on this model. And of course, models go over. So, and look at this bottom. This is very important. Bitcoin has gotten extremely undervalued in 3 different periods, and every time it was followed by a stark surge. In fact, the last time the surge happened halfway up the last big bubble in 2017, just like this bubble in 2021. And Bitcoin, guess what? 4-year cycles, late 2013, late 2017, late 2021 ahead. So Bitcoin probably is not over. If it breaks 28,000, it probably is, but Bitcoin could run to 115,000. Now, again, I'm going to show you what I use. People have all types of models. I am modeling the crypto movement, Bitcoin, cryptocurrencies, all this stuff like the dot-coms that came at the last bubble in technology. That's like, we got Amazon on the bottom and the internet index when it's in its infancy in the late 90s. So you had this first baby bubble and then it crashed. How much did it crash? 94% for the leader Amazon and 95% for the index. Oh, wow. And then incredible boom, incredible returns. This is a logarithmic chart, so it understates how strong that boom was. So if you had bought the internet stocks or Amazon after that first baby crash, like I'm projecting for the cryptos just ahead, you'd have made a fortune. I mean, just an absolute fortune. So that's what I see happening to crypto. So here's Bitcoin. Here is, if we can break above this little channel here recently, 42,000, it's likely to go as high as 115,000. I'm not going to go how I got that number. Some of the best people in the industry are pointing toward that, and I'm using their analysis, okay, and it's credible. If it can't break above this, next stop is 4 to 7,000. Remember, it crashes 94, 95% after this baby bubble. That's just history. That's the only thing you can compare it to that makes sense to me. It's not perfect, but nobody's got a better model than this. I listen to all types. I'm down here in Puerto Rico, saving a lot of taxes, by the way, and lower living costs. And I'm around tons of crypto people, and they don't understand this baby bubble thing. They don't think that they could drop 94, 95% before. I agree with them with the long-term boom in the next 15, 20 years, but I do see a crash coming first. So this would be the buy of the century. To wait for Bitcoin and Ethereum and leading stocks to crash into 2022 or 23 and buy them at the lowest prices in history before. Remember that earlier chart? Actually, I saw 100,000 now. The next step is 1,000,001. That could happen. Now, real estate. Not going to get into this in depth, but this was one of my breakthroughs several years ago. Every sector of the economy, I can take, okay, overall spending 46, 47, but real estate's 41 going on 42 now, okay? And different things are peak in the early 20s and in the late 60s even, you know. So every different consumer sector has their time when they boom more. What I found with home prices, since they last forever, is that I have to subtract, I have to not just put on a lag for the peak buyers, I have to subtract the people who die, who are sellers. Again, because everything else we consume doesn't last lifetimes, housing does. This model has been the best model I've come in a long time. It says, even though housing prices are only a little higher than they were in the first bubble, and that was a bubble, and that's a dangerous sign already, compared to the fundamental demand, this blue line, the real demand of peak buyers, less dyers, and baby boomers are going to do nothing but die for a long time, that we are about 40, 50% overvalued. I see a bigger housing crash than last time. So it's not just stocks, it's also housing. We're going to see a reset in all those financial assets that have been pumped up artificially by endless money printing for 12 to 13 years now. You do not get something for nothing, and I will stand by that. If we don't see a substantial crash by late 2022 or 23, I'm probably just going to quit my profession and go play golf or something. But I wouldn't do that because I'm not good at it. Now, signs now, home prices. Hey, all this stimulus. Well, eventually home prices get so expensive. I'm just doing a presentation the other day in Australia. There's $700,000, $800,000 there. Now, even adjusted, it's more like 600,000 compared to ours. You know, 374,000 for the median, everyday, I hate to say it, kind of pitiful house, okay? Home prices have gone high enough now that demand and sales are going down. And there's all types of things going on here. But the home boom looks like it may be over, and that's a big stimulus. Here are some warning signs, just technical indicators. What were the big peaks in the past? 2000, 2007. Here we are on Morgan Stanley's best indicator saying we are just as overvalued as we were in 2007 and more overvalued than 2000. Stocks are due for a major correction of some sort. And here's the classic Shiller price earnings ratio adjusted for cyclicality. 48 was the peak total earnings stocks return, and now we're up over 40. The second highest, higher than 1929. This is also saying, look out. I mean, even if nothing else I said today was true about demographics and weakness and overprinting and all this stuff, this model would tell you a good time to be out of stocks. And I'm saying real estate as well. So just summary points. Sell stocks, especially if we get a new high, like 4,500 plus in the S&P 500, and particularly by the end of this month, if not earlier. If stocks start to crash, remember that 50%, in 2 to 3 months. And actually the 29 crash was 49% in 2.3 months. It can happen that fast, and I think it will. You see stocks start to crash like that, then you better worry about real estate, because that's what will trigger a recession, and real estate will follow at that. Cash flow positive rentals and multifamily and medical facilities is a good place that'll hold up. Commercial real estate and high-end real estate will do the worst as usual. Don't think I got a dream home and it's a great place. I just sold a dream home on a dream island, okay? And happy I did it. That's safe haven. What I say, U.S. 30-year Treasury bonds, the AAA corporates only, not even, I don't even want to be A or AA if I can, only the best will hold up. Not gold, and definitely not Bitcoin. Bitcoin will be the worst place, will take the biggest crash. I'm predicting 95% when Bitcoin crashes before the next great boom. And create cash and cash flow now to leverage what I've been calling for years, the sale of a lifetime on all financial assets except the highest quality bonds, those Treasury bonds and AAA corporates. So again, I know this is a lot in 30 minutes, but there couldn't be a more critical time. I predicted the greatest boom in history when people thought it wasn't even possible with the rise of Japan and Asia, and it seemed like America was falling behind, and it happened because the fundamentals were there. I'm predicting this money printing is baloney, and it will not last, and it's already showing signs of crash. It's taking more and more and more, like any drug habit. This is like a financial drug we're living off of. They've been offsetting the decline of the baby boom for years. We need to reset, restructure our economy, get rid of zombie companies and debts so we can have a productive boom from 2023 forward when the millennials come along. But we'll never, and I'll tell you this today, in the US and Europe, we will never see a boom as long or strong as we saw from 1983 to 2007. So I'll leave you guys with that. We probably don't have time for questions. I apologize for that, but I wanted to get the information.
All right, Harry, thank you so much for that excellent presentation. It's always a pleasure to hear from you. All right, everyone, thank you so much for attending that great presentation. We are speaking with Harry Dent, harrydent.com. You're watching Money Show's Virtual Expo. Stick around. We have more presentation coming your way to close out the day. So thank you again for being here, and we will see you back here shortly.